Okay, let's dive right into this explainer of the source material by looking at a number that is quite literally reshaping the global economy right this second. We're looking at a staggering 92.7% collapse in commercial vessel transits through the Strait of Hormuz. And what's truly breathtaking about this near total logistical paralysis happened in just 48 hours following the military strikes back in late February of 2026. I mean, we went from a bustling global energy artery to an absolute ghost town on the water, practically overnight. Now, as a financial analyst reviewing this unprecedented macro finance crisis, my goal today is to really cut through the noise for you. I'm going to walk you through exactly how the effective closure of the world's most vital energy waterway is sending these devastating ripple effects straight through the physical economy. We'll look at everything from collapsing supply chains to a very real looming agricultural crisis. But we're also going to unpack a massive paradox. Why on earth global stock markets are somehow hitting record highs while the physical world faces extreme scarcity? So, here is our roadmap for today's analysis. We'll cover 1. The operational collapse, 2. Rerouting logistics, 3. The agri-food catastrophe, 4. The geopolitical standoff, 5. Financial dislocation, and finally 6. The post-Hormuz order. Let's get into it. Part 1. The operational collapse, moving from a vital artery to a total blockade. You've got to look at the sheer velocity of this breakdown. Back in 2025, you had about 138 ships cruising through there daily, no problem. Then the February 20th strikes kicked off this brutal cycle of kinetic deterrence. But the real nail in the coffin, operationally speaking, was the formal U.S. naval blockade established on April 13. We are now looking at a waterway that previously handled around 20 million barrels of oil a day, completely transformed into a trap. We've got over 1,000 vessels gridlocked, 800 stuck inside the Persian Gulf, and another 200 just waiting outside. And with war risk insurance premiums surging up to 10% of a vessel's total value, major carriers were effectively forced to abandon the route entirely. Which brings us to part 2, rerouting logistics and the massive Cape of Good Hope detour. Take a look at the colossal economic penalty of this detour. We're tracking a 278% spike in freight rates. They've jumped from roughly $1,100 to over $4,100 per container. You're adding 3,500 to 4,000 nautical miles to a single voyage, which tacks on an agonizing 10 to 15 extra transit days. And look, this isn't just an inconvenience for shipping companies. It creates a toxic wave of inflation. The cost of extra fuel, the port congestion, the trapped empty containers, all of that is being passed directly down the supply chain straight to you, the consumer. Now, we're also seeing a profound divergence within the energy markets themselves. On one hand, raw crude oil has a bit of a buffer. The IEA coordinated a massive 400 million barrel strategic reserve release, and that actually kept crude prices somewhat contained. But on the flip side, we are facing an absolute physical famine of refined products. Asian refineries just lost 80% of their Gulf crude feedstock. So finished fuels like jet fuel and diesel, incredibly scarce. Import-heavy nations like Australia are acutely exposed right now. They're facing prices of over 218 cents per liter for petrol, and their domestic diesel reserves are sitting at a very precarious 30 days. It is a textbook supply shock. Moving to part 3, agro-food catastrophe and the hidden input crisis. As a financial analyst, I have to warn you that the most dangerous secondary impact here isn't actually energy, it's food. The UN Food and Agriculture Organization is sounding their absolute highest alarms right now. You see, the Strait of Hormuz isn't just an oil corridor, it is the primary conduit for the global fertilizer trade. Nearly half of the world's exported sulfur, which is absolutely vital for phosphate, and 43% of its urea flow right through the single 21-mile-wide choke point. And because fertilizer application has a nonlinear impact on crop yields, missing those critical April and May planting windows means we're locking in disproportionately huge agricultural deficits down the line. That is going to drive global food prices through the roof. And the timing of this? It is exceptionally precarious for the global south. We're looking at acute exposure in places like Bangladesh right during their critical Boro rice season, and in India just ahead of their Kharif season. In sub-Saharan Africa, nations like Somalia, Kenya, and Tanzania rely heavily on these exact fertilizer imports. A lack of these specific inputs right now absolutely guarantees large declines in staple crop yields for the upcoming 2026 and 2027 harvests. So it's an input crisis, but it's evolving rapidly into a full-blown food crisis. Part 4. The geopolitical standoff, sovereignty versus blockades. Now, as impartial analysts assessing market risk, we have to view these opposing diplomatic stances neutrally to gauge just how long this shock might last. And right now, negotiations in Islamabad remain completely deadlocked. The United States is demanding a nuclear agreement up front to lift the April 13 naval blockade, their primary goal being to disrupt oil revenue. Meanwhile, Iran is insisting on an end to the strikes and formally recognize sovereignty over the strait, which includes the right to charge tolls, before any nuclear discussions can even be put on the table. Both major powers are deeply entrenched in rigid opposing objectives. There is no immediate pathway to reopen the waterway here. Adding immense pressure to this already tense impasse is China. Beijing has stated an absolute refusal to recognize the blockade, famously declaring, "The strait is open to us." As a primary buyer of Middle Eastern energy, China wants to secure its energy flows and is explicitly warned of naval escalation if U.S. boarding actions occur. They're also threatening aggressive countermeasures if retaliatory trade tariffs are implemented. This whole situation transforms a regional choke point into a massive global superpower flashpoint. Section 5. Financial dislocation. The AI buffer. Okay, so if you only looked at the stock market today, you probably wouldn't even know there was a crisis. We have a severe physical economy contraction happening, 10 million barrels a day of oil shut in, widespread fertilizer famines, massive shipping delays. Yet juxtaposed right against this, the S&P 500 and South Korea's Kospi Index are hitting all-time record highs. How is that possible? Well, equity markets are entirely decoupled from the energy shock right now, completely buffered by the massive global demand for AI chips and semiconductors. Tech earnings are effectively acting as a heavy shield against all this physical scarcity. However, that equity buffer cannot hide the grim inflation arithmetic waiting in the wings for us. As Morgan Stanley points out, every 10% rise in oil prices systematically adds 35 basis points to U.S. headline consumer inflation. This proves that the structural shift in energy and transport costs we're experiencing is not just some temporary blip that the tech sector can outrun forever. The underlying fundamental costs of making and moving things around the globe are rising aggressively. Consequently, global central banks are completely trapped. They were widely expected to start cutting rates in late 2026, but now they have to balance rising, sticky, supply-driven inflation against maintaining stable interest rates. The U.S. Federal Reserve is being forced to remain patient. The Bank of England is holding steady, and the European Central Bank is actively pivoting. A 50 basis point hike is now considered much more likely than a cut. We are locked into a brutal, higher-for-longer environment simply because, well, you cannot print more ships, and you definitely cannot print more fertilizer. Finally, Section 6. A post-Hormuz global order. The overarching takeaway from our analysis today is that the just-in-time supply chain model is fundamentally shattered. Think about it. A model optimized entirely for peak efficiency completely falls apart when the disruption of one single 21-mile-wide passage drives up the price of bread in Sydney and the cost of manufacturing in Europe. We're seeing security of supply rapidly replacing efficiency as the primary metric for global trade. So, I want to leave you with this final, provocative thought. We are witnessing massive, urgent shifts happening right now. Nations like South Korea are doubling their renewable energy targets, and countries like Australia are pushing incredibly hard for localized, sovereign manufacturing just to escape this exact type of vulnerability. Given the sheer trauma of this input crisis, we have to ask, is the 2026 Hormuz Shock the definitive catalyst that permanently ends Middle Eastern oil dominance?